Well, China ramping up stimulus this week. The People's Bank of China cutting the reserve requirement ratio, reducing the amount of cash that banks are required to hold in reserve, sending shares of U.S. listed Chinese stocks higher this week. But is this enough to help China's struggling economy? We turn to Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist, to tell us more. Jeffrey, is it that alone? I mean, there's also been some short covering as well. What do you believe is perhaps most pronounced within the tape, within some of the Asia Pacific but Greater China specific stocks?
I guess the size of the reserve rate cut, the reserve ratio cuts for banks have typically been 25 basis points over the last couple of years. So this was a 50 basis point cut to 10% for the largest banks. That's pretty big. I think the last time we saw that was in 2021 in response to the pandemic and the global slowdown we saw then. But when it comes to spurring demand in the economy, I think the cut is going to have limited effectiveness on its own. The PBOC's move does release significant liquidity to banks, which should help the banks support infrastructure spending and maybe affordable housing this year. But lower rates or more credit availability isn't China's problem. In fact, it may only worsen its ongoing battle with deflation, which is weighing on demand and profit growth.
Yeah, and Jeffrey, taking that into account, it sounds like then, to say the least, this rally that maybe we're seeing, you expect to be a bit temporary. I think the question, though, for investors is what that bottom looks like for the Chinese market. Have we seen that yet? Or I guess, what more specifically do you think that downside risk could look like?
Well, the real turnaround, the real issue is turning around consumer sentiment and not even stock market sentiment within China. It's this weak private sector demand while home buyer deposits remain at risk in the form of the liabilities of failing developers. Remember, you put down 30 to 50% in cash when you want a developer to start building your house in China. And now the troubles with those developers mean some of those deposits could disappear, and that's what consumers are worried about, a big loss of their lifetime savings. So reviving growth and confidence will require some type of explicit government guarantee of those home buyer deposits at those developers. Now, there may be more efforts by policymakers in the weeks ahead, leading up to the start of the National People's Congress on March 5th. In the meantime, China's efforts to prop up its stock market with some buying, and investors were calling the 60% jump, that 60 jump in Chinese stocks during the 3 months that followed the end of lockdowns in late 2022. Need to remember that all the efforts that China's put in place over the last year or so have been short-lived and quickly reversed in the stock market with further declines.
Yeah, the Chinese economy in 2023, the projection was for it to grow at about 5.4%. It's expected to slow, according to the IMF, to 4.6% in 2024. With the stimulus that they're putting into the system there, how and what is the probability that we will actually reach that figure for this year, considering we were kind of off of the grand expectations that we had at the start of 2023 last year?
Possible, but it's not good quality growth. What I mean by that is it's simply infrastructure. China's frequently had problems of, building ghost cities and bridges to nowhere. And that's one of the challenges is when China faces these slowdowns, they have a difficult time addressing consumer demand. And so you get government-sponsored spending. Now, that does generate growth and does have some spillover to the private sector, but it's not as good. It's not as healthy as actual consumer-driven demand. The consumer drives much of China's economy, as it does in the U.S. and elsewhere. So getting consumer sentiment turned around is the key here. So they could hit that target, but not in a way that's really generating a lot in terms of profit growth or consumer incomes.
So, Jeffrey, what's the advice there? What are you telling your clients in terms of the approach to this region? And if China doesn't look attractive at this point, how are you positioned then for 2024?
When I look to Asia, I'm much more excited about Japan than what I'm seeing in China. So Japan's stock market, the best performing one in the world so far this year, on the back of a 29% gain last year. Japan's got a number of things going for it, in addition to picking up manufacturing share from China as investors move, or businesses move to invest in a more friendly location, I guess, as you think about supply chains. I'd also add that Japan's putting in place some changes at the Tokyo Stock Exchange that are making enhancing shareholder returns in terms of more dividends and share buybacks. And of course, Japan itself is likely to raise rates this year, the Bank of Japan, and that may lift the currency. So also getting that wind to the back of investors. So much more excited by what I'm seeing in the developed market of Japan than the emerging market of China.
All right, Jeffrey Kleintop, always great to speak with you here. Charles Schwab, a Chief Global Investment Strategist.
Thanks for having me.
Thanks.